The third quarter saw equity markets decline sharply, with many indices posting the largest quarterly falls since the European crisis 4 years ago. The bulk of the losses came in August, when the market's fears around China's economy and plummeting stock market eventually fed risk aversion across all global asset classes. Few investments made money over this period. Against this backdrop, all of the Harmony funds delivered negative returns for the quarter. Considering returns net of fees and in local currency terms, the sterling and Australian dollar funds fell the least, by between 2.5% to 4.5%. The Asian funds suffered the largest falls, down by 8% and 10% for the balanced and growth profiles respectively, while the Euro and US dollar funds all fell by between 7% and 9%. Although returns for the quarter were disappointing, they came after a period of strong returns in the first half of the year, when most of the funds delivered low single-digit gains in their base currencies, while the Australian dollar and Euro portfolios delivered larger gains of approximately 5% and 10% respectively. Also, the high level of diversification we maintain in all of the Harmony funds across asset classes, investment styles, managers and currencies meant that the funds suffered lower drawdowns than equity markets during this period. Importantly, we have maintained our positions through this period of heightened volatility. Although this detracted from short-term performance, we believe consistently implementing our valuation-driven asset allocation approach should lead to strong long-term performance. Indeed, so far we have seen a strong rebound in markets at the start of the fourth quarter, which the funds have fully captured. Having reduced risk in the funds earlier in the year, after valuations increased substantially in certain areas, we believe valuations for the asset classes we are invested in are much more compelling now, leaving us feeling optimistic about the future return potential for the funds. Key drivers of fund performance over the quarter included divergence across regional equity market returns, equity manager selection, and fixed income asset allocation. On the first point, the performance of regional equity markets had a significant bearing on the variation in returns across the Harmony funds, as most of the funds have around 2/3 of their equity exposure invested in the home region. The US, UK, and Australian markets held up better than most other markets, despite all falling by roughly 6.5% in local currency terms, while continental Europe fell by over 8% and Japan by over 13%. Asia ex-Japan and emerging market indices fared worst, plummeting by 17% to 18% in US dollar terms over the period. Most of the funds have roughly 1/3 of their equity exposure in global markets, which contributed to returns for all but the US dollar funds, given the outperformance of global equities versus the other home markets, part of which is attributable to the boost from US dollar currency appreciation. Given the large declines seen across all equity markets, the Harmony growth risk profiles, which carry a higher equity weighting, underperformed the equivalent Harmony balanced profiles across each region. On the second point, equity manager selection had a meaningful impact on performance for most of the funds over the quarter. The area where this contributed most significantly to performance, in aggregate, was in the sterling and Asian portfolios. The most notable outcomes for individual holdings included Prusik in Asia, with outperformance of over 6%, and Lindsell Train and Evenlode in the UK, with both outperforming by approximately 4%. Sector selection was a key driver of many of these outcomes, with several holdings benefiting from having underweight allocations to the underperforming energy and materials sectors. The Euro and Australian dollar portfolios also saw positive but smaller contributions from equity manager selection. However, the US dollar portfolios saw a negative contribution, as our US active equity managers underperformed in aggregate. The most defensively positioned and quality-orientated of our selected managers outperformed, but this was insufficient to offset the underperformance of our growth and value-orientated manager holdings. Lastly, another notable factor driving fund returns was the performance of our fixed income holdings. Having generally contributed strong performance earlier in the year, all of our holdings across investment grade and high yield bonds, convertible bonds, emerging markets, sovereign and corporate bonds delivered negative returns for the third quarter. In most cases, they weren't down by more than a couple of percent, but in the balanced risk profiles, where we have a greater fixed income allocation, this still represented a meaningful detractor from performance. Ultimately, volatility and risk aversion reached such high levels over this period that we didn't receive the usual diversification benefit that we would expect from these investments. Only developed market government bonds provided some downside protection during this period, but we continue to view this as a very expensive asset class with low to negative return prospects over the next few years, and so we have virtually no direct exposure. In addition to rebalancing as necessary after large market moves, we made a few other changes to the funds during the quarter. Some of these changes occurred because market volatility provided us with attractive entry points. Specifically, we increased our positions in core US high yield bonds across all of the funds, and also added US investment grade bond holdings in the US dollar and sterling balance funds. In addition, we made a couple of new investments in a UK commercial property portfolio and in a US deep value equity manager. In the sterling funds, we invested in a London-listed real estate investment trust managed by Eddiston Real Estate. We believe their focused UK commercial property portfolio has good return prospects and will provide a significant diversification benefit to the funds. Indeed, unlike most other investments, it provided a positive return over the quarter. This investment decision follows numerous due diligence meetings with the management team over the last year, as well as visits to some of the properties they own. The portfolio we invested in targets income-producing assets with a typical value of between £10 million to £25 million, with initial yields in excess of 6.5%. The investment team are highly experienced at investing in assets which provide the opportunity to add value through a hands-on, active management approach. Meanwhile, in the US dollar funds, we diversified our exposure to US value stocks by switching some of the holding in the Harris Equity strategy to a new holding in the Conventum Lyrical Equity Fund. We believe their strategy can deliver meaningful outperformance versus the US market over the long run. The New York-based team are highly experienced value investors and have a particularly unique approach to portfolio construction, which we believe reduces downside risk and enables them to focus more attention on conducting in-depth fundamental research. Also, they manage just $4 billion in US equities, which allows them to access mispriced opportunities amongst small and mid caps as well as large caps, unlike many of their larger peers. We firmly believe these additions improve the performance potential of the funds, whilst also improving style balance and diversification.